Good morning everyone and welcome back to Morning Markets here at True Potential. I'm Kevin Kidney and today we're going to cover the UK jobs market, the latest data we've just had published, but we'll start with an update on bond markets. So we've spoken substantially in the recent past about the impact of government borrowing upon bond yields. That is, bond yields have moved higher in the recent past because governments have surprised, particularly in the US, with regards to the amount they wish to borrow. September will be a real test of that, particularly this week. Both the US Treasury and the Debt Management Office here in the UK return to the market with substantial borrowing needs. September also has the quirk of being a month of unusually large issuance from corporates. So that is private companies coming back to the market with substantial needs to roll over their debt. So we'll really see if bond yields have risen high enough to fund these borrowing needs from both government and the private sector. But let's turn to the UK and in particular jobs market data for the month of July, which was published this morning. What we're seeing is actually a worry now for both government and central banks. We've seen the unemployment rate tick higher again, but we're also seeing continued acceleration in underlying pay growth. In fact, pay growth now is the fastest since records began in 2001, and this is at a time when the jobs market appears to be slowing on trend downwards. And a particular concern will be the disaggregation of the wage growth strength. It's all coming through the public sector as a result of the lagged effects of settling strike action earlier in the year, and some of those awards catching up and now being measured in the official data. So whereas we're seeing public sector wage growth of around about 12%, we're seeing private sector wage growth of somewhere just above 7%. And of course, underlying inflation in the UK economy is around about 7% and trending down. So it's the public sector pay awards which appear to be ill-fitting with the current dynamic of the UK economy. So this is a major challenge for both central bank and government because the central bank is still seeing pay growth accelerate above inflation, but it's also seeing underlying weakness in the jobs market. And the challenge for the government is it's also seeing the underlying weakness in the jobs market, but the only area of strength is in public sector employment. That's growing faster, and that's actually probably going to be more of a burden on the taxpayer or the overall exchequer in the long run. So we're not seeing the growth impulse from increased employment in the public sector, but we are going to see tighter monetary policy. And that justifies why the Bank of England remains the only bank where markets expect further interest rate increases over the rest of the year. And as my colleague Paul Durrans referenced yesterday, we're likely to see that possibly communicated next week at the September meeting from the Bank of England. So in summary, we're still seeing this dislocation between wage growth in the UK but trending weaker in the actual jobs market, and the bond market is now priced for much higher borrowing needs but may be tested over the next couple of weeks. Thanks for now, and we'll see you tomorrow.